Do you remember the great philosopher Mike Tyson? Um,
Yes, yeah, you have a game plan until you get punched in the face.
Everyone's got a
There's some,
plan until they get punched in the
yeah,
mouth. And I'm thinking to myself, this is all going to be fine unless this economy absolutely gets whacked in the mouth, at which point the Fed will be a little late to have seen it. Welcome to Real Vision. I'm Harry Melandri, and today I'm lucky enough to be speaking to Teddy Vallee, founder and CIO of Pervalle Global. Pervalle is a New York-based discretionary global macro hedge fund. Hi, Teddy. How's it going?
hey, how you doing? Good, thank you.
Good, thank you. I read in some notes. I was looking you up, and it said that you were a soccer player when you were younger. Did I get
That's
that wrong?
exactly right. No, you got that exactly right. Yeah, well, a football player is everyone else in the rest of the world calls it the real
I'm a
thing.
Tottenham fan myself,
Oh,
so
there it is. There
yeah,
it is.
yeah.
Yeah, so grew up. That was sort of the goal to play professionally when I was younger. I was used to be on the U.S. national team, and then unfortunately in college I got too many injuries, so the doctor said, "Look, got to hang it up," and that's how I sort of got into markets and this whole game.
Knee injuries?
Head injuries
Oh
actually.
no.
Yeah, a couple concussions.
Yeah, you don't. Yeah,
So you don't really want those.
no.
Although it led me down a route of really focusing on health and understanding, your thought process and how you're thinking about things. So at the end of the day, I think it was a blessing in disguise.
Yeah, well, hedge fund manager is a good second best career to soccer player.
Yeah,
I
exactly
think
right.
so. I think so.
Yeah.
There's a guy called Espen Baardsen who was a goalkeeper for Tottenham. I think he became a hedge fund manager with Hugh Hendry after his goalkeeping career.
No
You should
way.
you should probably drop him a line. He's pretty good.
Absolutely.
Um, so anyway, my first observation, I was when I was doing my kind of due diligence, I looked at your results, and you guys have been absolutely hitting the ball out of the park. 21% Q1, 23% annualized since 2018. How did you do it?
That's a good question. I think just focusing on the process. At the end of the day, we're really focused on leading indicators of what the world looks like over the next 12 months. So for the past, from coming into the business to recently, I've just been obsessed and focused on what the world looks like over the next 12 months. So we built out a series of discretionary indicators of how I see the world or how the world could potentially could look, and then we've sort of augmented and added in the best parts of different practices that I've sort of seen. So we have a very, very heavy quantitative arm. So on the technical side of things, we're back testing results and understanding, okay, historically, if this has happened 54 times, what's the percentage positive over any period of time? Do we actually have an edge on this signal? And then aggregating a lot of these things on the trading side. So not only are we focused on where growth is in the future, but also managing risk around that and trading that growth. And then I think just being able to trade all asset classes. If you're able to jump from place to place and say, okay, look, the probabilities that we see for growth over the next 12 months are, call it 90% downside. What asset class is not pricing that in? And then really focus on that asset class. So we'll probably get into what that sort of looks like today. But today, the bond market, for example, is pricing in a much different probability than copper to gold is. So having the flexibility to jump from place to place, I think has been a huge edge for us. And then adding in the quantitative trading piece, and then also really focusing on the research process and sort of bottom up, top down together has been helpful. And then I think probably also just being obsessed with the game and not really. Last year, for example, we did not have a good year. But being able to stay alive and keep your head on your shoulders so that you're able to come back, I think has also been probably I picked that up from the athletic days or from playing soccer. So I'd
Right.
say that's in a nutshell sort of what we've been doing.
It's interesting. So, can we talk about how you're seeing the current global macro situation? I mean, tell me about the world. What is the most important thing for people to understand right now?
Yeah, I think I've really, really sort of downgraded the thought. When we came into this year and we were very, very negative on the bond market. We were both thinking growth and inflation were going to continue higher, probably through the end of Q1, maybe into a little bit of Q2. And the Fed was just completely offside, which would cause them to make to place this type of catch up, which would not be good for a lot of risk assets. And that's pretty much played out. If we look at some of the leading indicators looking forward, all of them are straight lower. The thing that I'm contemplating working with right now is that things are evolving at such a rapid pace that I would have expected some of the economic numbers that we've gotten recently, whether that be regional Fed surveys or some of the new orders to inventory ISM prints. I would have expected these things to play out over a longer period of time, but everything is happening at such a rapid rate that the slowdown today is really taking hold. And that's partially due to what the Fed has done. These were some of the largest 6-month moves in 2-year rates, mortgage rates, and et cetera, et cetera. That's leading to, I just saw today, the 2-month rate of change of median home prices is down 11.9%, which has never happened before. And you're seeing now huge big moves on the prices paid front. Yesterday, ISM came out with prices paid, and it was the biggest move to the downside in a decade, the 4th largest move since 1948. So things are just moving at such a rapid pace. So if I'm thinking about the world looking forward, I'm seeing growth that is still going down and accelerating pretty swiftly, and inflation is likely to follow suit as well. I think that's the biggest sort of variant view or variant perception I have on the inflation front, and could ultimately be wrong, but sort of my base case is that inflation is going to fade much faster, call it by the end of Q1 than the market thinks, and then many have sort of been pontificating on, and that's primarily related to a lot of the supply chains coming back on, but also just the demand destruction. If I'm looking at stock bond portfolios, they're down about 14 trillion from the high, which is 61% of GDP. These things lead demand, and are really starting to come through the numbers. If you look at wheat, for example, wheat's now off 44% from the high. This is below the pre-invasion price. 10 copper, both down 50, or sorry, 10 and many other sort of base metals are down 50% from the high. So I think these things are filtering through on the inflation front, and that's going to be the biggest sort of difference from where the market's pricing rates currently, and where I see things. So I guess relating a little bit back to what I was mentioning, we focus on these discrepancies, or as George Soros liked to call them, reality gaps, where we see something in the future and the market's not pricing that. If you look across every market internal on the cyclical and defensive front, they're all pricing in significant slowdowns, which historically have tracked with interest rates. So right now, for me, if I look across historical growth cycles, all of those ratios are tracking the average drawdown of a growth down cycle, except for bonds. On average, bonds are up, call it the long end, so 30-year treasuries are up on average 24%, and now we're down about 15%. So there's huge discrepancy between how bonds are trading relative to a normal growth down cycle and where we're at today. And that's become our largest focus, and it seems it's related to both the Fed and inflation. So if I'm looking out over the next 6-9 months, I think inflation is really going to undershoot to the downside, which is where you're going to have some significant amount of opportunity on the bonds, for example.
So let me clarify, because I think I followed the argument, but I want to make sure I did. There's lots of times when I think I follow something and it turns out I didn't. The markets are not fully consistent. You're saying the bond market is pricing in a smaller, is it the discrepancy in pricing is not consistent with the kind of recessionary indicators you see in lots of other markets?
Exactly correct.
The bond market really looks like there's some gravity pushing yields higher right now, and you're trying to figure out what that gravity is, and you put there's some probability it's inflation.
Exactly correct. So I think the two largest drivers of that upward gravity are I guess inverse gravity, are the Fed, and then constantly job voting. So for example, today we had 3 Fed officials come out and say, look, we're probably going to keep going, after we had Powell say, look, we're going to be a little more data dependent. It just total change of tone. So I think that's really putting upward pressure. And then also we're in an environment, such a high level of inflation that no one's really analyzed or traded this before. So I think from a market participant perspective, and you're seeing this in the treasury liquidity's come down significantly because market participants don't know how to handicap or think about something of basically a new scenario similar to COVID, where we've never handicapped, shutting down the whole world. No one's ever seen or really traded this type of inflation, so it's difficult to really handicap. And I think those two things are the primary drivers as to why interest rates are where they're at today. And in the sort of the same vein of I was talking about before with how fast things are moving, I think the market could and the Fed could, by the end of Q1, really, maybe even before that, really just recognize what else is going on in the economy, and you sort of have this swift, fast move down on the rate front. So almost similar to how fast they came up. So that's what we're really focused on, is that inflation piece and sort of the Fed. But the Fed is, they're always going to be late and focused on lagging indicators. And they, made it pretty apparent now that they're not going to really back off until you've seen consistent moves lower. Like Meister today came out and said, it's not going to be 1 month of crude declines. We need multiple months of this. So focusing on, I think they're sort of screwed. And this is sort of the second policy error that they made. The first was not moving fast enough, or recognizing that we were going to have some type of inflation, that the market was very strong, primarily because of the focus on the unemployment rate. Now saying, look, we're not going to let up until we see consistent, declines in inflation. And by that point, I think the economy is going to be in a very difficult place, and it's going to be pretty interesting to see sort of how this evolves. So that's what we're looking at.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
Obviously, I'm in a research shop. We're looking at the same things you're looking at. I was struck when you said that everything seems to be dropping really quickly. We've seen quite interesting things when we look under the hood of the US real estate market. Things that we hadn't expected to see. We thought we'd be. I thought I was paying attention. My colleague Julian was paying close attention. Turns out, if you look under the hood, there was hidden speculation, speculative investment in residential real estate in some frothy markets. The Wall Street Journal is telling us all about Idaho, Boise, Idaho being one, but everyone knows which are the frothy markets. It's always Florida, right? Florida's always a frothy market. San Diego's always if the real estate market in the US is going up, San Diego's always going up twice as much. And the same's true about, it's a bunch of hotspots. Austin, Texas, everywhere that millennials want to move to, that got kind of expensive.
Really expensive. I saw a really interesting chart on Austin, Texas, also, where the supply, if you look at sort of historical supply, it was normalized, sort of seasonal, and this time it looks like it's double the normal average supply. So
right, and what we missed is we thought we were looking at the home builders and thinking, the home builders, they don't seem to be stretched, but I think there was a lot of big corporate home building spec activity in those real estate markets too. Smaller individual contractors were taking money from what looks like private equity. I got sent by my boss, Julian, to go and look at what had happened in private equity markets. And I just couldn't believe it. There's like some comment from Jeremy Stein from like 2014, it's a Fed Governor Stein, and he said something like, the thing about monetary policy is it's a pretty blunt tool, but it has the advantage of getting in all the cracks. And that's true. If you leave policy really accommodative, that money's going to find some place to go. And it seems to me that a lot of it went into private equity in the last 10 years.
Absolutely.
So, anyway, so yeah, we see the same thing. Lights switched off in private equity and all those companies. Lights switched off in real estate. So it's economic activity is going down really quickly, more faster than we'd expect. If I were to diverge from you, I diverge from you on the question of inflation. Because like economic activity, we can slow in growth, but that doesn't mean that inflation is going to switch off. And I'm concerned that actually, if you're going to be wrong, you'll be wrong about the second leg of the argument, that slowing of growth doesn't necessarily cause inflation to drop.
I think that's a fair point. I think I would also caveat it with it saying that where inflation settles, I think is going to be a much higher level than where we've been. Call it 3 to 4% from the prior 10 years. The biggest concern I have on that front is on the energy side, and energy staying at a much. I mean, for me, I think crude probably bottoms if we head lower, it probably bottoms at $65 a barrel, barring some really really significant economic shock, just given the supply demand dynamics. But if I'm looking at some of the things on, for example, if I'm looking at home prices or leads of home prices, mortgage applications are straight down. So over the next 9 to 12 months, that's going to be very, very difficult. Vendor lead times versus CPI. Vendor lead times have basically completely retraced their whole move to the upside, which historically is correlated with CPI and indicating that we should have a pretty significant move lower. Real disposable income, deeply negative, leads CPI by roughly 12 months. And there's a few others that I have that I'm looking at on the inflation side, but I don't disagree that it might not come down as fast as, definitely not as fast as growth. But if I see inflation, month on month, or if we go from 9.1 to 6.5, I think at the 6.5 point, you can visualize and see. You then are able to, like I talked about previously, not being able to handicap sort of this 9.1 and what inflation is. If we could get down to 6.5, I think you can start to handicap again. Okay, 6.5, we could potentially get to 4. And at that point, it allows the bond market to then refocus on the growth scenario, which should consistently get worse. But to that point, I don't think, rates can make a new cycle low. So I think probably on the 10-year, 1.4, maybe you have an overshoot to 1%, but I think 1.4 is probably where you're going to bottom out at, given sort of the inflation piece. So if I'm really wrong on inflation, then maybe rates, find a low at, call it 2%, and stay elevated at that point, and just, take it down to 2 on the growth front, but the inflation is a significant problem and we stay elevated. But the inflation stuff in piece is definitely something we're thinking about and trying to, build new models and think about what it could look like.
So to kind of discuss this, we have to implicitly discuss a Fed reaction function, because all that matters is how the Fed reacts to data. It doesn't really matter so much what the data is. The market has to try and muscle the Fed otherwise.
Right.
So are you thinking that the Fed will resist rate cuts? I mean, imagine a situation where we do see inflation drop to, say, 6.7, which, by the way, I think is kind of counterintuitive right now. That's kind of the lowest it could get to, because the Atlanta Fed wage tracker is running at about 6.7. So you have to think that workers will accept, like the last inflation print was like 9.1. So on average, therefore, American workers had a wage cut of 9.1% over that 12 months, but on a 1 month point. I would try and claw that back. I'm not sure my boss would listen to me, but I would definitely ask for a 9.1% pay rise. The Atlanta wage tracker is showing a 6.7% and straight up. So, if you're in a sector where you can ask for a pay rise, you're going to get it. If on average Americans get 6.7% pay rises, either margins get crushed, which is fine by me. I don't care. I'm not long equities.
Yeah, exactly right.
Or some of that inflation gets transmitted through and it persists.
The one point I would have on that, one thing that we track pretty closely is the Treasury daily statement. So basically, what's the wage withholding component of that's being reported or collected daily from the Treasury? And if you look over the past 3 months, that's faded significantly, which also sort of correlates with the CPI. So that's something that we're really, really paying attention to. Is this sort of on a 3 month annualized basis, bottoming it out here? Which probably, if you, I don't want to give exact numbers, but if you comped it to that 6.7 number of the Atlanta Fed that you were mentioning, it's probably down pretty materially from that 6.7 print. And actually, after this, I'm going to put those two together and see if there's actually a correlation. But that's something that we're tracking pretty consistently, and you get it on a real-time daily basis. And can sum it up, and that's it's faded significantly, which also sort of plays to that inflation slowing piece that I have. It's also very, it's probably one of the more lagging pieces, the wage
Sure.
front, but that doesn't necessarily mean it couldn't stay elevated. On a nominal basis, we just continue to print these levels. That's, I think, to me, and why we're tracking that daily wage data so closely. If that does stay at a much higher level or maintains its sort of its levels, then that's going to be a problem on the inflation front, and therefore a problem with sort of the rate view.
I think in any given economy, well, if you were a conspiracy theorist or something, you'd say the whole point of what the Fed's trying to do is to create an environment where you're discouraged from asking for a 9.1% pay rise. Create
Right.
enough slack in the labor market where you think maybe I should accept a 3% pay rise after all.
Right. Right.
And that's certainly true in the UK, by the way. You can see that all over the UK market. But I'm thinking about this Fed reaction function, and I've got a view on the Fed reaction. What's your thoughts on how this Fed will behave? Like three Fed speakers coming out to protest on a day, that's definitely
Yeah.
coordinated. Those guys were told to go do that.
Yeah. Exactly right. I don't think they're gonna. I can't see cuts for a while. So I think the cut is effective. Like the old cut would be basically them pausing and saying we're hanging out here. And the reason that is because you're not going to see CPI come down materially until probably December of this year. So that's a long runway for them to completely sort of change course. So I think because they move in such slow motion and they're sort of like the Titanic versus a speedboat, they're going to say, okay, first reaction function is them pausing. We're evaluating things. There's been some softening in in the labor market, which there hasn't been yet, unless you look at claims. Demand side softening a little bit. And then I think once they really start to see month-on-month CPI, so maybe 2 to 3 months, then they're going to start to make potentially, telegraph, look, we've done our job. But at that point, you're probably going to still be looking at a 6 handle on CPI, which is materially above their target. So I don't know how they could say, okay, we're going to cut. They've done crazy, stupid stuff before, so maybe they say, there's a huge uptick in unemployment, but they've also said previously, look, we're fine with that's actually in the forecast, right? That you're going to see a pickup in the unemployment rate. So they're boxing themselves in to have to be too aggressive again, which is probably why I'm more interested in the long end versus on the short front, the short part of the curve. But I can't see them getting materially dovish. It's only incrementally dovish from their current sort of reaction function.
You're definitely you're talking flattener. You've got that. What you're saying sounds very much like you like flatteners or forward steepeners, but not spot steepeners, because those rate cuts aren't going to come. So you buy the tens,
yes.
you buy tens till they get down to it, but that's going to limit the extent of the trade.
Right.
So I'm guessing you're positioned at the long end of the curve, not the belly of the curve or the front end.
Exactly correct.
Yeah, on this Fed reaction function question, I'm lucky. I've worked in research shops specialized in Fed watching. So I got a network of contacts who were, professional Fed watchers. I call them up and ask them, give me a freebie of what's going on. And the gist that I'm told right now is that everyone at the Fed is looking at the mistake Arthur Burns made in 73, 74. And nobody wants to be, if you're Jay Powell, you don't want to be remembered as the second Arthur Burns, the guy that ushered in the big phase of inflation in the 2020s. So right now, that's what I'm hearing as well. That's what you're hearing, I can infer. The only thing is, you remember the great philosopher Mike Tyson?
Yes, he. Yeah, you have a game plan until you get punched in the face.
Everyone's got a plan until they get punched in the mouth. And I'm thinking to myself, this is all going to be fine unless this economy absolutely gets whacked in the mouth, at which point the Fed will be a little late to have seen it. And
Right.
what you and I are both, I'm seeing it in private equity. You've seen it in real estate. Um, Things are dropping away very quickly, even if inflation isn't dropping away. So somebody's
Right.
going to get a really nasty uh, decision they have to make about whether to look through current inflation or whether to and assume it will come down or
Right.
whether to stay the course. And I wouldn't want to be in a position of having to make that judgment call.
No, absolutely not. We really focus on the market internals and sort of what the markets are saying, and all of these things. The velocity which they've fallen has been pretty incredible. I mean, copper on like a 30-day basis was down, 21% or something like that, which only happened 2 or 3 times in history. One was in the heart of '08, one was '96, when there was, I believe, a cornering of the copper market. So it's the velocity at which some of these things are moving is incredible, and for the Fed not to view it in the name of inflation, I think is ultimately going to be not the right decision. It's the question now. The question is, when do they recognize that that's not the right decision, and what sort of triggers them to say, okay, we've seen, this is enough. Let's pare back. And it seemed like Powell last meeting was hinting at a little bit of that, and that's why equities rallied. But today, you see rates come down a bit, and then the Fed's back out again, saying, "Look, this is enough. We're going to do this until we see 2 to 3 months of persistent downside on the inflation front." So I think maybe the claims data continuing higher, or the unemployment rate really starting to tick up. And if you look at some of the leads of both those, they should start to pick up from now through the end of the year. One being sort of consumer confidence, the other being, if you overlay the housing index, NAHB, and invert it, both those are sort of indicating that we should see a pretty big pickup in the unemployment rate over the next, call it 6 to 8 months. The issue is that, it's government data and it gets revised, so who knows if it's actually going to come through in the next few months. We might be a huge uptick now that we don't recognize until, middle of end of next year type of thing. So.
That's right. That happens almost every big turning point. You only find out in the rear view mirror that
Exactly
actually
right.
all the data you were
Yeah.
looking at was wrong, and they revise it all. You
Completely
go like,
right. Yeah.
especially employment data.
Yeah.
But on the employment front, I mean, one of the things that worries me about this, and it's not what I want to focus on, because you said something I really did want to focus on, but there's a lot of COVID mess in that data, and
Yeah.
under the hood, when you dig a little bit, it does look as if we've lost a lot of workers, um, predominantly female, predominantly above the age of 50. They just didn't seem to come back to the labor force.
Hmm.
And that's, I see it when I go and get an ice cream with the kids. The people serving me are 16 years old and can't work out what the peanut allergy protocol is because it's too complicated to wash a spoon. Um, all those ladies above 50 who used to do lower income jobs, they're not bothering. So doesn't that kind of give you the risk that in fact we don't see the unemployment shoot higher, it crawls higher, and there's more labor hoarding and stuff like that, so everything gets muddied up and slowed down. We get a slower reaction to the tightness.
Yeah, and I think that, to me, that just solidifies even more my negative growth outlook, because those folks that are not coming back in the labor force, you need to find someone else to incentivize them and pay them to fill that job, which causes the wage piece
Yeah.
to increase, and which causes the prices to increase of everything. So if I look out and look at some of the prices paid globally, which lead demand, it's straight down for the next 12 months. So the demand piece is incredibly clear. And I think that, some of the COVID distortions have definitely played a part in that, and also played a part in the Fed missing sort of the strength of the economy, because you also had a huge amount of folks that retired early because their 401ks were, through the roof, and
Yeah.
their net worth was phenomenal. So they came out of the labor force. I think that cohort, however, is probably going to now have to come back, given that their portfolios have been cut in half.
I shouldn't giggle.
Or
I shouldn't giggle.
they're
No one's going to find that funny apart from me.
Yeah. I think unfortunately they're going to have to now come back into the labor force, because what the Fed has done on the tightening front and what it's done to financial assets. So this is going to force sort of reignition into the labor force. which could also have some downside pressure on inflation, but I don't have a ton of confidence in that, and that's also sort of difficult to quantify, but it's definitely out there.
So the thing that I was very curious about, and you might want to not answer this because it might be too proprietary, but you talked about markets not being consistent. And what you gave one example, which was gold copper. Gold copper didn't seem to be, the ratio of gold copper doesn't seem to be consistent with the where bonds are trading for where we are in the cycle. One of these markets is wrong. Which one is it?
Right.
Have you got other examples?
Yeah, so we've aggregated an index of probably 17 different market internals similar to copper gold that we use to price and think about sort of rates in real time. A couple of the other ones that are interesting, big ones that everyone has historically looked at: banks to utilities. So how are banks doing? Cyclical stocks relative to utilities. Consumer discretionary, equal weighted consumer discretionary relative to equal weighted consumer staples. That ratio has gotten smoked recently. High beta relative to low vol. It's bounced over the past few weeks, but aggregating all of these, we're currently pricing rates at, call it, 1.8%. And interestingly, on the 10-year. And interestingly, the last time you saw such a large divergence was the end of 2018, when we were going through a similar quantitative tightening type of thing. And then you had the two sort of catch down. And it was also sort of why I was losing my mind at the end of last year. I thought everything that happened in the first quarter of this year was going to play out in sort of the back half of last year. And all of the internals and what the markets were saying were that growth was improving, and that inflation should improve as well. And that did not manifest until the first quarter of this year. Now I think we're in the overshoot, and now we're digesting sort of Fed policy, and likely will come down after the inflation piece becomes less of an issue, or we bring in the ability to effectively handicap inflation again and not be worried about, we're going from 9.1 to maybe 12. I think after we cut those tails off, I think then we'll be able to refocus on the growth piece, but that might not be for a couple months.
I was trying to figure out where you stood on emerging markets, both debt and equity. And I thought you had an interesting take on this. Talk to me about your EM view right now.
Yeah, so I have a different view every day, but over the longer term,
that's happening to a lot of us right now.
Yeah, so I think right now, I mean, I'm net positive right now, which is difficult given sort of what's going on the Fed side. To me, it seems, if I think about the dollar, and the dollar is a large part of it, and this is more short term, and I'll get into sort of the longer term thinking. I feel like the bias, if I'm correct on growth and I'm correct on inflation, the bias and the probabilities favor the Fed being more dovish than hawkish, given what's priced into these different assets. So on the EM debt and EM sort of currency side, I'm interested in it, especially given the carry. I'm really waiting though for some type of, and I thought the last Powell press conference was sort of it, but then today, the distribution changes after the saying we're going to keep going. I think right now the most interesting thing for me short term also is that you've had a complete divergence in economic cycles between China and the US or the rest of the DM. Historically, everything's traded in line. But after COVID, China did no economic stimulus. Now you're seeing, okay, we've done enough. We have a problem. We really need to crank on the stimulus front. And they're going sort of all hands on deck, which I think, and starting to come to the data now, leads to a large sort of reflation growth improvement out of China that spreads through the rest of EM. Now that's happening at the exact same time that the US and the rest of DM is slowing for, call it, the next 12 months. Those type of divergences we haven't seen in years, which to me is very dollar negative. One, the Fed is going to likely have to back off because of the growth piece and the issue with unemployment rising at the same time that China is then reinflating and adding additional stimulus to the rest of EM, which is very positive on a growth differential basis. So that, to me, I'm waiting sort of, and that's also very positive for precious metals and things of the sort. I'm waiting for that dynamic to sort of play out a little more, and we're not quite there yet. So I've basically been dipping my toes in. When I said change my mind and I take it off, I'm like, oh, like today, take it off, and then I'll add it back on when things somewhat interesting. So that's probably over the next, I'm trying to get into that over the next call it 6 months. Um, but if I look out longer term, I think we've had a complete change in the the macro makeup of global economies where fiscal is sort of the new monetary policy. So we can't cut rates anymore. We're on the zero bound. How do we stimulate growth? Or if we have, God forbid, another pandemic, what do we do? Well, it seems to me that they've now recognized, okay, we can do some type of fiscal stimulus, which is the exact opposite of the past 10 years. So the past 10 years, we've effectively, the U.S. consumer deleveraged their balance sheet. Japan didn't do anything, and Europe was doing fiscal austerity. We now have a situation where Europe is doing, you just put in place a $1.5 trillion next green energy package. The U.S. has done an incredible amount of fiscal, and Japan's talking about, $500 billion to $1 trillion deals. That to me raises global growth profiles. And if you have global growth profiles that are trading at higher levels, that the capital is not going to come to U.S. technology companies. And the reason it's come to U.S. technology companies is because there's been no growth in the rest of the world. So where do we put it? Well, we put it in tech companies that have growth regardless of the economic backdrop, which causes more capital to come here, which strengthens the dollar, which causes basically the rest of the world to get priced out again, which strengthens the dollar more. So that reflexive feedback loop that we've had for the past 10 years, I think is now flipped post-COVID, and now is positive sort of from the commodity front and fiscal spending front, that allows capital to then leave the U.S. and go to these different parts of the world that have not done very well. So I'm thinking much longer term. I'm very interested in areas of the world that have larger commodity exposure or do well under fiscal types of programs or benefit from that. So it's a huge change, and that's, I'll never trade on that, but it will be in the back of my mind from a growth cycle perspective. That's probably where we're shifting to, and then restructuring trades during sort of up cycles and down cycles based on that thesis in the back of my head.
Damn it, Teddy! You made like 6 different points. I got to unpack them all. So I kind of agree with everything. I'd put it together a little differently, but I kind of agree with the bigger themes here. I definitely agree with your point about let's call it global capital scarcity, where the Europeans want to build out their energy infrastructure. Venezuela would like to reconstruct. Argentina would like to roll over its debts. Everybody needs capital right now simultaneously, and not financial capital. They need real physical capital. And that's not something a Fed can generate. The Fed can generate liquidity, but it can't undo scarcity. Right now, I'm a little concerned by how tight monetary policy is in the States. I'm long all sorts of emerging market debt for my personal account because I'm an idiot. And that has cost me a fair amount of money, right? And I still like the trades. I'm not walking away from those trades. I think the stuff I own has double digit, double digit.
Exactly.
Some of them in the high 20s. Argentina's already restructured once. How many times are they going to restructure in this move? So I like those trades, but they've cost me money. I think they're costing me money because the Fed is placing a lot of stress on the global dollar balance sheet. And I'm hearing some fascinating anecdotes. If you cut off the supply of PE capital, private equity capital, to West Coast entities, their suppliers have suddenly noticed a big drop in business. Their suppliers are probably located in China. They probably had dollar requirements. They were counting on those dollars coming in, and they were going to build you a bunch of servers and send them over real cheap. Now they haven't got those dollars, but they still have that dollar debt that they kept. So I'm hearing noises that sound a bit like a dollar crunch out there, and I see dollar crunches, shortages of dollars all over South America, given where these bonds are trading. Let's put it this way: if the Fed is waiting for something to break in North America, they might miss all the stuff breaking globally,
breaking the rest of the world. Yeah, exactly.
Before that happens, so it makes me a little nervous because stuff could get really hairy when that goes. And I see why you're stepping out the way, for the time being. Although there's been a big bounce in the last 2 to 3 days.
Yeah, it's been nice. I think as we get closer to, so my time frame on a lot of the things I'm thinking about is by the end of Q1, where you see, growth is going to be in a very bad place. Inflation, I think, will be coming down materially from here. Where it settles, I don't. Maybe you're at 3% by then, but probably closer to 4. As we get closer to the end of Q1, my conviction on EM debt or EM currency increases, and now sort of playing and staying alive to then will be contingent on what these academic bandits want to come out and say. But I think I would have a significant amount of confidence the closer we get to the end of Q1.
Academic bandit? You mean our central banking friends? Surely.
Oh, right, those guys. Yeah,
Yes.
exactly right.
So on the dollar, so I watched a fascinating interview of Harold Malcolm, Pippa's dad, I think. And he gave an anecdote where he said that Janet Yellen was talking to big Asian investors. So you kind of know who I'm talking about. Like there's big Asian investors in places like Singapore, Malaysia, whatever, government, state wealth funds, and telling them that she believed the dollar would remain very underpinned by the Fed, and that this made U.S. stocks a safe playground, a safe sandpit to play in. I was really struck by that because it tells you something about midterms and what the priorities are, but it also tells you something about dollar policy. Do you think they can hold the dollar if they keep the dollar strong? So how long is the dollar going to stay strong for?
I think it's really contingent on what China does. So if China gets their act together, or really reduces some of the lockdowns, and has their credit has a significant pickup in basically the infrastructure investment of the credit, which recent data would say that should be coming through, called Q4 of this year. I think if they continue that, then the dollar, I think the Fed staying hawkish will not be enough to hold the dollar up. If China, though, has an issue and we have real estate problems continue in China, and some type of additional non-positive growth backdrop, I think the dollar could go much higher. And if the Fed doesn't pivot, then I think it's just going to either stay flat or go up. But to me, the biggest sort of driver and thing I'd be looking for is China's credit really starting to pick up. And if so, then I get a lot more confidence in that EM thesis, and basically the dollar fading.
I am sure you're right that the Chinese authorities are going to try and reflate. And Chinese bonds are probably a good trade. My question mark is how much of that is going to be allowed to bleed out across the exchanges. That I've been reading like Chinese economists' recommendations in their big gathering they have, and one of them recommended decumulation of dollar reserves, which is like counterintuitive, but it makes more sense when you think about what happened to Russian reserves, and that the Chinese authorities should look to run a current account, should stop running a current account surplus with the United States. And I thought to myself, oh my God, if China does that, where will that put the dollar if they reverse that policy and start decumulating dollars? And that will give you fewer dollars that they're buying on, fewer dollars they buy, fewer treasuries they buy. That might push US interest rates a lot higher. I speculate on it, and these things, usually the Chinese, very slow to change what they want to do, right?
Absolutely.
Can I ask you about crypto? It's hard to find a subject I know less about. Yep. So, what should I be thinking on crypto?
Yeah, so to me, crypto is probably, so there's multiple different pieces of crypto. So I think the most basic thing to focus on is just probably Bitcoin. I think Bitcoin, to me, at the end of the day, is an inflation hedge as it relates to monetary debasement. So crypto as a whole completely responds to the global liquidity cycle. Where is called global M1 heading over the next 12 months? If that's up, crypto does well. So all of crypto's returns have come from either global growth up cycles, which happen to historically coincide with global liquidity cycles. Bitcoin, to me, is the one piece that has consistently outperformed the increase in money supply. Now, it doesn't always mean it goes up. So like right now, we're moving in the opposite direction. So crypto should not do well. But if I am looking out and I'm saying, okay, there's going to be a huge increase in liquidity, my favorite way to express that would probably be through crypto. That's sort of Bitcoin, which I view as itself. I mean, the whole industry benefits from huge increases in liquidity. But there's multiple different ecosystems and things getting built out that are also of interest. But I think a lot of them still have time to basically have real world benefits, or are priced at a level that assumes they're providing those benefits today. So I think there's a ton of interesting things. It's just at what point at what price do you pay for that? So I would say if you're focused on crypto and want to own it, I would own probably Bitcoin, Ethereum, just a couple of the main tokens, and that's going to get you done for the global liquidity cycle. Now, when things turn, it's probably the last thing I want to own, and we were fortunate enough to really lighten up significantly coming into this year, because we said, look, like the Fed is going to have to make significant moves, which is going to tighten liquidity, and a lot of our leading indicators already are saying liquidity is tightening. So I think from a macro perspective, you have a huge edge over in the space, because if you know what the world sort of looks like in 12 months from a growth and liquidity side of things, which is primarily what we focus on, you have a pretty good idea of where you should allocate, or how you should allocate, or how much you should sort of size it up and size it down. So from a macro guy's perspective, I would say really just focus on it from a liquidity point, and think about Bitcoin being the main outperformer of just increases in global money supply, which I think the trend is probably from the lower left to the upper right.
But as I said, I don't know that much about it. I've been thinking about it more and more recently to try and have a better understanding of it. And like that big 64,000 or 35,000 feet kind of perspective, to some degree, it bothers me that crypto is so big, because for me, historically, crypto is a private sector money, and private sector monies only get leverage or become prominent when the state is weaker, when governments are weaker. So it's a bad symptom, if you see what I mean.
Yeah.
But really, I'm not such a great investor in these things. I don't really know what I'm doing, and my original thought was, buy it at 11,000, leave it all alone, buy Bitcoin at 11,000. Have you got a better rule of thumb I should be using?
I think that's probably pretty good. I think, I mean, for us, it's, really, I'll send you the leading indicator and say, look, this is where it's going. You should do it now. But for us, it's really just, if you subscribe to the view that it outperforms increases in global money supply, then it's sort of a set it and forget it. Okay. And I wouldn't really focus too much on it, because, I think there's a great chart that shows that 95% of all returns have come from like 10 days or something like that. So if you miss those 10 days, or you're out of the market for those 10 days, it's difficult to catch up. So it's more of a set it and forget it type of thing.
Yeah.
But at the same time, if you do want to be a little more active, if you see the Fed being crazy and having to sort of change course, then take it down a little bit.
So when I was reading through your Q1 newsletter, because I'm a really interesting guy, honestly. I was reading through it. I noticed you use a Twain line, which is, it ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. In my experience, that's absolutely right. I think any poker player knows it too. What will get you in trouble? What is it that you're sure about that you suddenly think to yourself, maybe I shouldn't be so sure?
Yeah, I think one thing for sure is that we're in a mid-cycle sort of slowdown. That growth is not going to decelerate at the same level that I'm sort of expecting, or that markets or mini markets are currently pricing. That's sort of the thing that I've been thinking about. Do we not actually have rates trade down materially from here? And this is sort of just like a pausing in growth, and there's so much sort of excess savings on the sideline that causes growth to not, it comes down. We have a classic growth cycle, but things are much better. That's one for sure, and I probably would ascribe a lower probability to that than an issue on the inflation side. So some type of, I think from the also, relating back to a little bit what we were talking about previously, the Fed's reaction function seems to be completely correlated with basically what's going on in the oil market, or primarily gasoline, given that there's an unbelievable correlation between consumers, forward 1 year or 3 year expectations of inflation and the price at the pump.
Sure.
So if that to me is sort of the biggest thing that keeps me up at night as it relates to my thesis. One, the market not focused on growth, purely focused on inflation, and two, having some monster leg higher in the price of gasoline. That would be a problem for the short-term sort of thesis, but also in the reaction function of the Federal Reserve. At that point, I think they would be, the reversal that they would need to have to allow the market to then say, okay, let's focus on the growth, would not be present. And that would definitely get me in trouble. So it's something we sort of have hedged in the options market, and are thinking about. And then, assuming that situation happens, I could see equities going down materially. And there's been a very strong correlation basically with prices at the pump and the S&P, inverse correlation. So
yeah.
That's something that we're definitely focusing on, paying attention to, and as well as sort of this mid-cycle potential slowdown thing.
Yeah, when you have governments doing their best to take 10% of global oil exports and exclude them from the market, there's always a risk they get lucky and manage to do it.
Yeah, right. Yeah.
So finally, I come to the most important question of all. So it's almost the start of the Premier League season. What's your prediction for top four in the UK in the English Premier League?
Oh man, you're putting me in a tough spot.
It's always tough questions here, everybody. How do you know that?
Yeah, so exactly correct. I'd have to go. So I'm a little biased. So my team is now the New York City Football Club team,
Okay.
with ties with Man City. So I'm gonna have to do Man City at number one. Man City, Chelsea, United, and then there's a small team, I'm not sure if you heard of it, called Tottenham, that I think maybe comes in fourth this year.
It's where I grew up.
Hi.
Teddy, thank you so much. It's been a great pleasure speaking to you. I hope we can do it again.
Absolutely.
Oh, and by the way, Mazel Tov with the returns, man. You're hitting the ball right out of the park.
Thank you. So far, so good. Just trying to stay focused and execute.
Have a good one, man.
Thanks, Harry.
That was an excellent interview between Harry and Teddy. We were given some great insights into how Teddy was able to significantly outperform the market so far this year. Here are some takeaways. Teddy is focused on leading indicators. He uses them to paint a picture of what the world may look like in 12 months and invests on that basis. He focuses on research and uses a bottom-up and top-down approach. He also credits being able to trade all asset classes as a reason for his success. In terms of his macro outlook, Teddy expects growth to continue to slow and decelerate quickly. He also expects inflation to start falling soon and come down materially, probably in December of this year. In this scenario, he sees long-term bonds as an opportunity. He believes pricing in the bond market is not consistent with the kind of recessionary indicators he's seeing in a lot of other markets. When it comes to emerging markets, Valle sees a major shift in the macro makeup of global economies, where fiscal policy will become the new monetary policy. As a result, he sees growth profiles around the world rising and expects money to flow out of the US into markets around the world. He's focused on countries with a large exposure to commodities, or ones that will do well under fiscal types of programs. He's not trading on that thesis yet, but it's in the back of his mind. When it comes to US dollar strength, Teddy thinks it's completely contingent on what happens in China. He believes a stronger China means the dollar will get weaker, but if major problems in the Chinese economy persist, the dollar could get stronger. On the crypto front, Teddy's favorite way to express a huge increase in liquidity is through digital assets, specifically Bitcoin. But when liquidity decreases, it's the last thing Teddy wants to own. The point here is this: it's important to have a view on liquidity in order to have a view on cryptocurrencies. Finally, Valle acknowledges that there are a couple of things that keep him up at night. He says that he could be wrong on his growth call and that it may not decelerate materially from here. He also thinks a major leg higher in the price of gasoline would make him rethink his macro thesis.
We hope you enjoyed the video. At Real Vision, we help you understand the complex worlds of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.